Whether you are just starting a nonprofit or have been in existence for years, your organization will need a budget. The larger your organization, the more complex the process may be, including creating multiple project or department budgets with the help of several staff. Even a one-person shop needs a budget which details the basic income and expenses of the organization. In order for the board to adequately manage your nonprofit's financial health, it needs a benchmark to measure current income and expense against. A budget can also help predict tough financial times and will give the board time for contingency planning if grants or other income sources fall through. Lastly, funders will require a budget if you're planning on or applying for grants. New organizations may start the budgeting process by looking at potential income, figuring out how much money they have to spend. Existing organizations will have an easier time developing a budget as they will be able to review its history of contributed income and stability of earned income revenue streams, such as fee-for-service or organizational dues. So no matter where you start with the budgeting process, the first part is always the planning stage. The planning stage is through strategic management, and it basically states that your budget needs to be tied to the missions and goals of the organization. It also needs to consider alignment with your internal and external demands. So to be able to reach the organization's internal capabilities and external demands, the first thing to do is take a look at the strategic management process that organizations go through. The strategic management process consists of 5 different steps. Step number 1 is defining and developing a mission statement. The organization's vision is a general statement of its intended direction that evokes emotional feelings in its members. The firm's mission statement further defines the company's purpose and operationalizes the vision of top management. The second step is setting strategic goals. Top management's broad vision and mission are translated into operational strategic objectives during this step. Step 3 is formulating a strategy to achieve the strategic objectives. A strategy is a course of action that explains how the enterprise will move from the business it's in now to the business it wants to be in, given external opportunities and threats and internal strengths and weaknesses. So step number 4 is discussing how we go about implementing the strategy. You need to draw upon the functions of the management process, which allows management to translate strategy into action and results. And lastly, we want to evaluate performance and correct anything as required. Strategic control involves assessing the firm's progress towards its strategic objectives and making corrections as needed. Strategic control keeps the company's strategy up to date. So now let's take a look and see how nonprofits actually use their budgets. There are many uses of budgets within a nonprofit organization. The key 2 that are mentioned in most literature on the subject are for planning and control. The key to success of a budget success is whether they have been planned with much foresight and sensitivity. In these circumstances, budgets can have many advantages. They can aid in planning, which gives a business direction. A budget takes the organizational plan, including goals and objectives, and quantifies this into something tangible to aim for. Such forward planning aids anticipating future business conditions and helps avoid otherwise unforeseen problems. Budgets also play a role in control within an organization, so it can be used to measure performance against the targets set in the budget. The budget remains the mainstay of performance measurement in many nonprofit organizations. The budgeting process can encourage communication between departments because employees aid in the coordination of the firm's activities. The budget can be used to communicate financial plans throughout the different parts of the organization, thus showing how the different parts fit together to form an integrated plan for the organization as a whole. There is also argued to be a motivational role for the budget. if set at the appropriate level. The budget gives managers a target to strive towards. However, there is also an argument that if it is set at an inappropriate level, too high or too low, it can have the reverse impact and can demotivate employees. So now let's take a moment and look at some different types or styles of budgeting. The two primary styles of budgeting are incremental budgeting and zero-based budgeting. Each method works differently, and they both have their advantages and disadvantages associated with them. Incremental budgeting always begins with the budget from the last period. Once there is an established starting point, if a department needs more money than the previous budget, they have to be able to justify the extra expenses. Also, if you do not use your budget, then the next period's budget will be reduced. This type of budgeting often leads to wasteful spending by employees because they do not want to lose their budget. Zero-based budgeting, on the other hand, begins the new budget from an established point of zero. Instead of starting off with last period's budget and adding or subtracting from it, you begin with zero and then go through every expense that you will incur during the course of the business. This budgeting method uses more detail and makes everyone accountable for their necessary expenses. The biggest drawback with this method is that it requires much more work to implement this method and is often unpopular with the employees. So when preparing a budget in an organization, regardless of the approach that you take, they should always mirror your chart of accounts and tie back to your financial statement. Most importantly, it really should tie back to your cash flow statement, otherwise referred to as your cash flow budget. This is the budget of revenues received and expenses paid. It's broken down monthly to ensure cash will be there when needed. If an organization expects all of its expenses in the first 3 months of the year and all of its revenue in the last 3 months of the year, the organization will be unable to pay expenses unless it has built up a large cash surplus. So you need to plan your cash flows as well as your revenue and expenses. In addition, you want to have consistent format because that'll aid in meaningful reporting and will keep things consistent across the organizational board for reporting purposes. So within budgets, we have revenue and we have expenses. And within each of those, we have drivers that really propel us forward with our revenues and our expenses. So let's take a moment to really talk about what revenue drivers are. Many nonprofit organizations hold to the conventional wisdom that nonprofit revenue diversity is good and concentration is bad. While the balanced portfolio approach to nonprofit revenues might suggest that there is some security in diversified revenues, I propose that diversity is the wrong starting place for developing a nonprofit revenue model. It's where we ultimately want to end up, but not where we want to begin. Instead, I believe that the concepts of reliability and autonomy are the real drivers of nonprofit revenue planning. Assessing the reliability of revenues ensures that you meet your budget and how autonomous dollars often increase resiliency, adaptability, and fuel innovation. Some nonprofit organizations actually achieve reliability through a strategy of revenue concentration. So the first principle in developing a revenue model is to have a thoughtful exploration of your agency's reliability and autonomy of revenues. While many revenues are possible, not all revenues are going to be feasible. Once you understand the reliability and autonomy of your current revenue, the next principle is to vet the options for expanding revenue. While many new revenue streams might be accessible, your pursuit of new revenues should be constrained by your organization's acumen to plan, execute the plan, and have the patience to see the investment yield returns. Part of this feasibility planning is to consider the cost of adding new revenues. We also need to understand the cost of new revenues. This principle of developing a revenue model should be fully considered and not underestimated. Every change in your revenue model comes at a direct and indirect cost. Two indirect costs are obvious. Each new revenue stream takes to develop and manage, and each new revenue stream brings another potential taskmaster in terms of accountability, restrictions, and reporting. Both of these place additional burden on administrative costs. Further, while it is obvious that the skills to be a successful grant writer are not the same skills for raising individual donation, often nonprofits try to expand their revenue strategies using their existing capacity. Unfortunately, this often leads to mediocre or even disastrous outcomes more often than it leads to successful outcomes. Anticipating and planning for true costs of raising revenue greatly increases your chance of success. Operating revenue is not investment capital into the nonprofit organization. Most nonprofit agencies understand the unique role of capital campaign. Raising money to renovate, buy or build a facility, or raise money to purchase a new delivery truck is an effort above and beyond operating revenue. However, I would propose that beyond investing in building and trucks, nonprofits should think of expanding revenue streams as a capital need and consider planning a capital campaign for the infrastructure, which would include staff and technology, which would also be required to expand your revenue model. Donors need to understand how their investments will create a long-term return within your nonprofit organization. The major mistake a lot of nonprofits make is that they do not formulate action plans. They decide they have a plan for revenue model, but it's not written. It is only an idea. Many nonprofits spend lots of time talking about changing revenue models, but avoid putting in the time, effort, resources, and structure to create a formal revenue plan. Is it hard to find the time to meet, plan, and decide what to write down? But without a plan, you risk having the strategic overwhelmed by day-to-day activities. Written plans are critical to your success, whether it is embedded in a larger strategic planning process for your agency or developed as a standalone document. In either case, a clearly written business plan guides your decisions related to revenues. Then you want to make sure that you communicate your revenue plan. This is going to be essential. A well-written revenue plan opens the door for different conversations with your existing funding agencies and donors, and opens doors for conversations with new potential funding agencies and donors. A clear plan, executed well, will go far in raising understanding, confidence, and attract investments in your plan. A revenue plan in tandem with a clearly focused strategic plan is the basis for communicating about your potential focus and drive. And lastly, you need to implement, monitor, and adopt your revenue drivers. The financial principle is that developing a revenue model and plan is the easy part. The challenge is to stay focused, implement, and fearlessly adapt. The best of plans may fail if a board of directors does not take its participation and oversight functions serious enough, or if an executive director is under-equipped to hold staff accountable for performance. Yet, even in the best of circumstances, your revenue plan needs to be a living document with room to adapt and change. So let's take a moment now to talk about expense drivers. Nonprofit organizations are required to summarize expenses by function in either the Statement of Activities or the Notes to the Financials, as well as the IRS Form 990. Presenting expenses by function gives important information on how the organization uses its resources to potential donors, funding sources, regulators, and the governance board. In addition, nonprofit organizations are often evaluated and rated based on their level of spending on programs compared to administrative fundraising. Expenses are typically identified as either program expenses, fundraising expenses, or management and general expenses. Program expenses are usually tied directly to accomplishing the mission or purpose of the organization. Fundraising expenses are those expenses that can be identified as part of a fundraising event or activity, such as sending out a mailer to solicit funds for the nonprofit. Management and general expenses include the cost of record keeping and oversight. Some expenses have elements of all three categories, and this is where a sound allocation process is beneficial to the organization. Having a written cost allocation plan in place ensures these indirect expenses will be appropriated to each category in an objective and consistent manner. The allocation between these categories does impact the total cost of your program. Greater management, general, and fundraising, direct and allocated costs results in lower program costs. This can be a deterrent to prospective donors and a potential red flag to regulators and the governance board. So what are some budgeting best practices when nonprofits need to prepare their annual budgets? First and foremost, you want to make sure you focus on both revenue and expenses. Many small to mid-sized nonprofits, when preparing their operating budget for the year, only report their anticipated expenses with little idea or knowledge of the internal revenue that will be coming in. So it's very important when preparing these budgets that you consider both revenue and expenses. If you are not a new startup organization, you need to review historical data and consider current trends in the market. So do you have increased revenue coming in? Are expenses going up this particular year? And you can use the historical trends to really track this and project what the future is going to bring. You need to also recognize that the budget is a tool to help guide the managers in their day-to-day activities, what they can expend, what they cannot expend, and it helps to keep some cost control containment within the nonprofit organization. It's not in the budget isn't an excuse. So many nonprofits will say they can't do something because they didn't budget for it. While the budget is a guide for how you should be bringing in revenue and expenses for the particular year, it shouldn't stifle growth and innovation. It should be used as a tool to indicate how to work your revenue and expenses to possibly implement new innovation. Maybe we need to increase revenue. Maybe we need to look at cutting expenses. But it should not be used as an excuse to not innovate and grow your nonprofit organization. Typically, from year to year, there should only be a 5 to 10% change overall in your revenue and expenses. So that's what we would be shooting for. If we saw dramatic changes within the expenses that are greater than 5 to 10%, we may want to take a closer look at that to see why that's happening and what the accountability for that is. And when it's a new program, you want to make a plan. You want to plan for at least 3 years out. So as you're working on this, having a 3-year budget to show how possibly, initially it may cost you more to launch the program, how over time revenue should really catch up to the expenses where the program is in a point of sustainability. Because that's ultimately, with a budget, what nonprofits are striving for is to gain a sense of sustainability and working forward to show that their potential donors that there is a good investment into their nonprofit organization. So a budget is a very key component to an nonprofit organization, and needs to be used on a yearly basis to track revenue and expenses, and it needs to be monitored throughout the year.